After 2 years of hard market conditions, the U.S. directors and officers insurance market stabilized toward the end of 2022 as pricing increases moderated and renewal pricing was flat on average, according to new AM Best special report. It was a welcome sign for some, as D&O liability coverage was one of the property casualty lines most under pressure heading into 2022. But will those rates withstand the ongoing pressures facing the D&O segment? Here to discuss some of those and other D&O issues are two analysts behind that new Best Special report, Associate Director David Blades and Senior Industry Analyst Chris Graham. And David, let's start with you. Can you give us the highlights of the new AM Best report?
Well, definitely. I think as you outlined in your opening, a lot going on in the D&O marketplace. It's a very dynamic marketplace. I think the different global economic challenges that corporations are facing have created a lot for directors and officers to have to manage in terms of, for the success and the favorable operations of their companies. What we saw in 2022 is it was definitely sort of a year of transition for the marketplace. We'd seen after years of historical underpricing, and largely due to just the level of competition in the marketplace, we saw from 2019 through 2021 dramatic increase in pricing, slowly going in 2019, and then in 2020 particularly hit a crescendo, kind of continued through 2021, and we actually then saw in 2022 the deceleration of sort of year over year renewal pricing increases. And by the end of the year, we saw things going towards more of a flat renewal placement in terms of renewal rates. So we saw that transition in the marketplace, and that's a large part of kind of what the story is. Whether that's sustainable is, I think, the real key. Definitely a question in our minds as we look at the numbers and as you continue to think about the volatility in the equity and bond markets and some of the other challenges that we're facing out there from an economic standpoint, whether that's going to be sustainable for the D&O market to stay in the softer conditions that we are seeing now, not only from pricing, but also from a terms and conditions perspective. In the report, we also look at just the overall we have an exhibit in there from 2011 to 2022 where we look at direct premiums written for D&O overall using the NAIC's D&O supplement, looking at those premiums and kind of looking at the direct loss ratios. And we see where the direct loss ratios, although there's some volatility, they were generally increasing during that period. So again, that supported what we then saw, which was largely probably a market correction in 2019, 2020, and 2021, when companies kind of looked at not only you're looking at things from a direct perspective, but the net results that they were seeing in their D&O books and the deterioration that they saw that generally caused the upswing in rates and in pricing, overall pricing. We also look at one of the things that's sort of an indicator for the marketplace is security class action filings. Generally, the more security class action filings, lawsuit filings, generally for D&O liability rates, they generally have gone up. And so there was a period where you saw 2017 through 2019 where those security class action filings were increasing. And again, that supported the need for the market correction. So we kind of, give a good historical look at what was happening, what caused the market correction that we've seen. And then, like I said, we look at what we're dealing with right now. You still got equity and bond market volatility. We still have interest rates that are going up. You're still dealing with lingering, the supply chain issues. Social inflation is still an issue, litigation funding. So some of those are the factors that we see potentially plaguing corporate directors and officers in terms of factors that they have to deal with managing their businesses. And from the insurance companies that are covering them, it's all those factors, again, mentioning social inflation, litigation funding, those factors are increasing. However the settlements work out in some of the lawsuits, just the expenses that they're having to deal with. So you got the expense side and the loss side that are creating challenges. And again, whether the softened market that we've seen, those softened market conditions coming into 2023, whether they prove to be sustainable is something that we talk about in the report is definitely highly questionable.
Well, I guess another indicator would be IPOs, and the report does touch on IPOs. Is the IPO market cyclical, or are we seeing some sort of trend here?
Well, I think definitely it's proven to be cyclical. The recent decline in IPOs. I think a lot of that just has to go with the tough economic conditions we were in. The volatility and the uncertainty in the stock market, et cetera. I think that just, it didn't create a great conditions for, a spike in IPOs. Although there was a period right after, the onset of the pandemic, the initial recovery kind of sparked a different type of IPO, not the traditional IPOs, but the IPOs led by special purpose acquisition companies. And so we saw in 2020 and 2021 a spike in SPACs, as they're called. And so, we saw that trend upward. And again, those SPACs or those types of combinations come with similar risks that you see in IPOs, similar types of lawsuits, especially post the merger of the special purpose acquisition company and its target company. You might see activity coming out of there in terms of lawsuits filed against the new ongoing operation post merger. So we did see, again, IPOs cyclically because of the economic conditions and just the tough and volatile economic environment. We have seen, IPOs in general, traditional IPOs trend downward, but with those SPACs, even though SPACs started and kind of moderated in 2022, but there are still many of them that kind of went through the process of being formed and now have to find target companies for their mergers. So we'll see what comes out of that and whether that has an impact on some of the D&O liability, lawsuit activity or claim activity.
Chris, should we be surprised about how much surplus lines is gaining market share when it comes to D&O?
Good morning, John. No, we shouldn't be surprised by this at all. This is what happens typically when you see a hardening market. As rates go up, companies will turn, companies, not the insurance companies, the insureds will turn to the surplus lines market to get tailored coverage and possibly save a little bit on premium as a result. So what we see in the spike in surplus lines coverage is normal for where we are in the overall market cycle for D&O.
Who are the top writers in D&O, and is that shifting in any way?
Well, XL remains the top writer of D&O by a fairly wide margin over anybody else. The only real shifting that we saw, if you look at our report last year versus this year, you would see Berkshire Hathaway made a large jump. That was largely from its purchase of Allegheny. Overall, on a like-to-like basis, they actually dropped premium from last year, which we saw almost across the board. 14 of the top 15 D&O writers wrote less premium in 2022 than they did in 2021. The cutoff for the top 15 that we show in our report for 2021, it was $320 million of premium. We actually had 3 companies in our top 15 below that threshold this year. The cutoff was about $270 million of direct premium written. This goes with not just the rates leveling off that we saw, but the drop in IPOs that David mentioned. That's less demand for the transactional risk on D&O insurance.
Thanks, Chris. David.
Yeah.
Thank you, John.
That was Christopher Graham and David Blades. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.